The balance sheet, aka the statement of financial position, is one of the three main financial statements we want to focus on when we're analyzing a company's performance. So the balance sheet tells us about a company's assets and how those assets are being financed. Do you remember this equation? Assets equal liabilities plus equity. So we see assets on the left-hand side, and on the right-hand side, we see how those assets are being financed. Assets can either be financed with liability accounts, such as short-term debt, long-term debt, or by equity, such as common shareholders giving cash to the company in exchange for shares of stock. So let's take a look at a sample balance sheet. So we'll take a look at Walmart, and here we see their assets, and I will scroll over and you'll be able to see the right-hand side of their balance sheet. We see liabilities and equity. Okay, so you always have assets equal to liabilities and equity. Now, you see that it's as of January 31st, 2021. This is a balance sheet right here. And then we actually have a second balance sheet right here as of January 31st, 2020. So we have two balance sheets. This is a comparative balance sheet here for Walmart. So here's one balance sheet and here's another balance sheet. Now, notice it's always going to say, so as of a specific date, as of January 31st. Okay, so right here, this amount, which is in millions, so it's cash and cash equivalents. Walmart had $17.741 billion of cash and cash equivalents as of January 31st, 2021. That's of that specific date. The next day, it would be different. So it's not for a period. Remember, the balance sheet is not for a period of time. It's for a point in time. And I've even got a quote here from Warren Buffett's professor, Benjamin Graham, just reminding you that there is no balance sheet for a quarter, for a year. It's at the end of the period. Then they present a balance sheet. They prepare a balance sheet as of that date. Okay, so it's at the end of the fiscal year. Walmart prepared a balance sheet. And we can see the assets on the left-hand side. On the right-hand side, we've got liability and equity accounts. So we're talking about how are the assets being financed. They had $252 billion in assets as of January 31st, 2021. How are those assets being financed? Well, we can look. We can see that they've got different liabilities. We've got short-term borrowings, $224 million. Not very much for them, at least for you and I. That's a lot of money. Long-term debt, $41 billion, so quite a bit of long-term debt. And then we've got the equity accounts here. Okay, so we got equity, we've got liability accounts. We're going to dig into those a lot more. And you say, well, why does this matter? Who cares how much they have in short-term debt or long-term debt? Why are we even looking at a balance sheet? Well, we might want to know, how creditworthy is Walmart? Maybe you are thinking of lending money to Walmart, and you want to know, are they going to be able to pay you back? Okay, so you've got a lender, or it could be that you are a supplier. Maybe you're Procter & Gamble and you sell a lot of product, okay, so to Walmart, and you ship them the inventory, but maybe you haven't been paid the cash yet, right? You ship them the inventory on credit. Walmart is buying from you on credit, so before you ship them a ton of inventory, you want to know, are they going to be able to pay me? And so in terms of creditworthiness, we can calculate a number of ratios, which we'll talk about in the videos to come. We'll do ratio analysis, and we can look at things like Walmart's short-term liquidity. Short-term liquidity, by the way, is just basically within the next year. Within 1 year, is Walmart going to be able to satisfy, any debts that they have? We'll look at things like the current ratio, the quick ratio, and so forth. I don't want to go into too much detail, but basically short term, when we talk about short term, we're talking about within 1 year. Is Walmart going to be able to pay its bills? But also we can look more beyond 1 year and look at long-term solvency. So we've got ratios for short-term liquidity, and we've got ratios for long-term solvency. The type of ratios we have for long-term solvency, we have like a number of different types of debt ratios to see, like, oh, is it like 60 or 70% of their assets are being financed by debt? Or is it maybe just 20%? Like, what is the split between debt and equity in terms of financing these assets? Okay, obviously a company that has like 90% of their assets being financed by debt, there's risk there, because what if the company runs into hard financial times? You still got to make those interest payments, right? Whether times are good or times are bad, you got to make the interest payments. So if 90% of their assets are financed by debt for some company, you'd be like, well, even though this year might have been a great year, in the long run, it's pretty highly leveraged. So there could be issues. And we can also look at interest coverage rate. Maybe they have a lot of debt, but is their profit a really high multiple of the interest expense that they have to pay? We're going to talk about that all a lot more, but for right now, just focus on, we look at this balance sheet as a way of saying, hey, are you creditworthy? Can you pay us if we ship you inventory on credit or if we lend you money? Now, the balance sheet does not tell us the fair market value of the company. Okay, it does not tell us that. However, it tells us something called the book value. So when you take the assets of the company and you subtract the liabilities, you're left with equity, right? And so equity is sometimes called the book value of the company. Okay, now that stockholders' equity, total stockholders' equity of the company, is not the fair market value of that company. That's not like the price someone would pay to buy the company. I want to be really clear. So you say like, well, why do we even care about what the book value is? Well, we can calculate things like market to book value, the ratio of the market value of the company to its book value. And we think about whether a company is, if you're an investor and you're thinking of buying a company, is this company like a value stock? Is this a good buying opportunity? And we'll talk about that later. But another thing, in terms of thinking about if the company is maybe teetering on the verge of bankruptcy, and you look at the balance sheet, you say like, well, how would this be helpful? You just told me it doesn't tell you the fair market value of the company. That's correct. But if we look at the assets, so let's just say, so as of the time I'm making this video, Walmart is not in any danger of going bankrupt. But let's just say that you were concerned that it might be. And you say, okay, well, if this company does go bankrupt and I'm a lender, and let's say that I think, they're going to go bankrupt, and I don't think they're going to be able to emerge from bankruptcy, because sometimes companies reorganize, and let's not get into that. But sometimes when they go bankrupt, they're liquidated. You sell off all the assets, you pay all the liabilities, and so forth. And so I'm thinking, okay, well, if the assets are sold off, which of these assets have value? Well, cash, that clearly has value. Receivables can often be sold for cash. Inventory, well, yeah, we could maybe try and liquidate the inventory, sell it to some other company, but what if they don't want it? Now, thinking about something like goodwill, okay, that's not going to happen. If this company goes bankrupt, that $28 billion of goodwill, we're not getting anything for that. We're not getting anything, okay? So again, I want to be clear, when we look at something like property, plant, and equipment, this $92 billion, that is not the fair market value of the property, plant, and equipment. That's the book value. But this gives us an idea. We're looking, we say, okay, we're not getting anything for that goodwill in a bankruptcy. So we have some idea of some of the values of the firm based on the balance sheet, okay? Now, when we're thinking about, can this company pay dividends? Or maybe can they increase? Maybe they already are paying a dividend, like Walmart pays a dividend. So maybe we're saying, hey, could they pay a higher dividend? Maybe we could, if we bought up enough shares and we really try to pressure them and get people elected to board of directors, maybe we could get them to increase the dividend. Maybe that's something that we see as a worthy objective. So when we're thinking about can they pay dividends or not? Well, how much cash do they have? Right? You might have heard in the news for years, you'd have people say, oh, you know what, Apple should be paying a higher dividend, or this company or that company. And sometimes there were tax reasons for why they might have profits overseas. They don't want to repatriate them. I don't want to get into all that here. But sometimes you'd have an activist investor saying this company should pay a higher dividend. And the question is, well, do they have the cash to do so? And you find that out by looking at the balance sheet. Also, do they have the cash to make necessary investments to keep the company going? You think, well, what investments does Walmart need? Well, if they're going to open more stores, that's obviously going to cost money. But what about keeping their stores updated? Do you want to walk into dirty grocery stores? And, you don't want to walk into a dirty retailer. How often are you going to go back? You're going to take your kids there if the place seems like a dump, right? So they want to make some investment in keeping the stores clean and so forth. So we can think about that, and there's ratios we can calculate related to that as well, okay? Now, rates of return, we cannot calculate. So if we think about, we're going to talk about like return on assets, return on equity, return on invested capital. You can't calculate that just with a balance sheet or statement of financial position by itself. You're also going to need the income statement, right? So you can get the profit of the company, but then you divide that, for example, for ROA, take the company's net income divided by average assets over the last two balance sheet dates. Okay? And so you take the assets or the equity from the balance sheet, and then you combine that with the net income or some other profit figure from the income statement. So rates of return, how profitable is this company given the assets it has at its disposal, given the equity that was put up by shareholders and so forth. Okay, so we're going to calculate all those ratios. We're going to get into a lot of ratio analysis. But as I said, the balance sheet is not perfect. Number one, I already told you, it does not tell you the fair market value of the company. And so you might have been wondering, well, why is that the case? Well, some things that we would think of as an asset, with just an asset being something that has future economic benefit, which is technically, so like per U.S. GAAP, for example, the definition of an asset is something that the company owns or controls that has future economic benefit. Now, you would think of some things like, for example, brand value. Like Coca-Cola. Why are people drinking Coca-Cola? You say, well, it tastes good. Well, is that all there is to it? There's also a thing, maybe they drank Coca-Cola since they were a kid, and when they see that Coca-Cola can and all this, there's a certain image that comes in their mind and says, yeah, I used to drink that Coca-Cola with my parents or with my little brother or whatever. So you think of the brand value, right? Brand value. It's not just sugar water. To somebody else, there's a perception that it's something more, Coca-Cola. But brand value is not going to appear on Coca-Cola's balance sheet. And we could talk about why later, but certain things that you would think of as an asset, per the accounting rules, they don't show up on a balance sheet, even though they're very important to that company's success. Now, other assets might show up on the balance sheet, but they're understated. For example, if you were to start a website and you pay money to register a domain name, okay, when you're just starting your website, nobody knows about it yet, you can get the domain name really cheap if it's not like some competitive domain name that tons of people are wanting. So if you get some obscure domain name and you just register it for $50 or something, but then, your company becomes the next, I don't know, let's say Facebook or something, or Google, and then all of a sudden that domain name is really, really valuable. But the domain name is going to appear on the balance sheet at historical cost. So not all the assets on the balance sheet are measured at their fair market value. Some are. Many types of investments are on the balance sheet at fair market value. And it gets to, why is that the case? Well, it's difficult to value the fair market value of some types of assets, like a building. Are you going to have the company every single quarter go and get an appraisal for what this, or what about the trademark of Coca-Cola? What is that worth? Okay, so just per the accounting rules, some things are not recorded on the balance sheet, even though you and I would think, yeah, that's a valuable asset to that company. And other things are on the balance sheet, but they are understated. Maybe their true value, we would say, is $10 billion, but it's on the balance sheet at $1 billion. Now, companies also make efforts to keep some things off the balance sheet. For example, debt. Okay, so off balance sheet financing. That was made a little bit more difficult with the new lease accounting standard, but there are still ways, like if a company set up a joint venture and so where they could keep debt that they're possibly responsible for, that you and I would think, hey, you might have some responsibility here to pay that debt, and they can structure transactions with their subsidiaries in some cases where they would not have to report any of that debt on their consolidated balance sheet. We're going to get into all this in all its glorious detail in the videos to come. So in terms of tools for analyzing the balance sheet, what are we going to use? Well, we're going to do a lot of ratio analysis. When I talked about short-term liquidity, long-term solvency, thinking about, this company, how leveraged are they? Can they pay their interest and so forth? We're also going to create something called a common size balance sheet, where we'll express every line item on the balance sheet as a percentage of total assets. And that will be helpful to see wow, 90% of this company's assets are inventory or what, and so forth, or 45% of this company's assets are goodwill and so forth. So that can be helpful. And then also we'll show you how to make a trend balance sheet, where we're basically looking at the percentage change over time. And you say well, how would that be helpful? Well, what if we saw that the company had 150% increase in accounts receivable? So the receivables went up by 150%. And you said, that's great. Maybe they're selling a lot more credit sales. They're doing a lot of sales, and the sales are increasing. And I say, well, we looked at the income statement and sales went up by 10%. So sales went up by 10%, but receivables went up by 150%. Could be a problem. Could mean that, well, maybe some of their customers are having trouble paying. Maybe some of the sales aren't really sales. Maybe some of them are bogus sales and so forth. This could mean a lot of things, but we're going to dig into all that. We're going to do a lot of ratio analysis, make common size balance sheets, trend balance sheets, look at how balance sheet items are changing over time. We're going to do all these things in the videos to come.